The argument of free gold is essentially that gold's price is finally freed in order to absorb surpluses, and in particular surpluses around energy and commodities, rather than treasuries and US financial assets. I think free gold has begun. And if that's right, the reason why it's important is gold could have way more upside than many people think even possible. And I say that with JP Morgan having just come out with a headline today saying they think gold go to 8,000 to 8,500, which I think is a very important statement coming from JP Morgan, because this is not like LukeGromen who can say, I think gold's going anywhere. If China was having a financial crisis, if its people were in severe problems nationwide, and I'm not saying there aren't problems there, of course there are. If nationally, on average, the nation was having a problem, China would be selling gold hand over fist, not buying it. Go back to Russia. Go back to Korea in 1998 during the Russian crisis, the Southeast Asia crisis. They were selling gold hand over fist to get dollars.
The argument for free gold suggests that the metal is finally being unleashed to absorb global surpluses in energy and commodities, effectively replacing US Treasuries as the primary reserve asset. This structural shift implies that gold has far more upside than the market currently anticipates, a view recently validated by JP Morgan's stunning $8,000 to $8,500 per ounce projection. Such a forecast from a central institutional bank marks a turning point, signaling that the move toward higher valuations is no longer just a fringe theory. LukeGromen, founder of FFTT, LLC, and a renowned macroeconomic strategist, breaks down the geopolitical signals confirming this shift. He points to China's behavior as the ultimate litmus test for this thesis. Historically, nations facing systemic collapse, such as Russia in 1998, liquidate their gold reserves to raise liquidity in a desperate bid. The fact that China is buying gold hand over fist, rather than selling it, contradicts the narrative of an internal crisis, indicating instead a calculated strategic pivot away from Western financial assets. Now, we present the clips from LukeGromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
From RR, what do you think is driving Chinese retail demand for gold and silver? Is it just flight out of real estate assets, and shadow bank collapse, general distrust of Chinese banking system, worries about a yuan devaluation? Volumes at Shanghai Gold Exchange have been spiking. I think it's none of those things. I think we're hearing that that's what it is in the West, but that's not what it is at all, in my opinion, and based on what we're hearing from people there, which is, as my friend Simon Mikhailovich says, gold is money that is off the table. That's not understood in America. In America, dollars are his money that's off the table. In most of the rest of the world, gold is money off the table. And I think it's important, I really want to hammer this home. If China was having a financial crisis, if its people were in severe problems nationwide, and I'm not saying there aren't problems there, of course there are, but I'm saying if nationally, on average, the nation was having a problem, China would be selling gold hand over fist, not buying it. Go back to Russia. Go back to Korea in 1998 during the Russian crisis, the Southeast Asia crisis. They were selling gold hand over fist to get dollars. Diametrically opposite reaction in China. China is waving gold in. Or if you prefer an example closer to home, from 2003 to 2000, ongoing, but most of the gold's gone now, 2003 through 2020, here in the Rust Belt of America that has been hollowed out, that has had a bad economic time for the last 25, 30 years. Have we been buying gold or selling gold? Let me tell you, this region has been a net seller of gold for 25 years. And go around most of flyover country America. Lots of we buy gold stands. You don't see a lot of we sell gold stands, right? Like you see in New York City in the gold district, or in London in the gold district, or in China where you see lines out the door for people to buy gold. In America, it's all in flyover country. We buy gold. You sell gold. So, when was America buying gold? When was America waving gold in like the Chinese are? 1900 and 1965. Think about that. So I think, I keep seeing China's gold buying as a sign of weakness. I think it's 180 degrees opposite. It's a sign of strength. It's a sign of stability. It's a sign of they understand what's happening here. This is not their first movie culturally, and understanding what's happening with global debt, they know gold works. From PKP, the market is sniffing out a change in priorities. We're seeing a cool off in tech names, especially software, and a run up in precious metals and base metals. Is this a temporary reprioritization, weeks and months, or something more permanent that persists for the rest of the year? In my opinion, it's going to continue for at least the foreseeable future, next couple quarters. Let's start. Is AI a bubble or not a bubble? Well, if it's a bubble, bad for tech, okay. If it's not a bubble, then software as a service and some of the tech high flyers, they might see some competition, particularly in software, as you noted. Maybe even just on pricing pressure. If it is a bubble, then I think it's going to be good for gold if/when it bursts. If it's not a bubble, then I think it's good for raw materials and inflation, because we're increasingly seeing copper and aluminum and labor, etc., are the bottleneck. And that is then also therefore good for gold, because only a fool owns bonds when metals inflation is running 10, 15% or more per year. And so I think it's going to persist for the next few quarters, barring some sort of drastic event that shakes everything up. This sort of shift to the metals and to gold and precious metals away from sort of tech. And like I said before, Nasdaq's down 45% in gold terms since early 2024. So this has been ongoing, and I think it's going to continue ongoing, particularly relative to gold, given what's been happening geopolitically. From Jerry, my old employer fund doesn't have the option to invest in gold or miners. I've come out of equities, sitting in cash. Would you recommend staying out of equities until the U.S. stock market drops 20% plus to historically normal valuations? In my opinion, you can't look at equities in dollar terms in a vacuum. I think you have to look at equities in real money, gold terms, in which case, like I said, Nasdaq's down 45% already since early 2024. So equities, I don't know. I like electrical infrastructure equities, but I don't love equities broadly here. So I understand your sentiment there. I would put at least some of that cash into gold bullion if it was me. Doesn't have to be all of it. Doesn't even have to be most of it, but it probably should be some of it. And so that's how I would think about that. From TS, yes, talk about the free gold concept, but only if you think it has a place here in the future. It's funny you say that, because I was literally had an ex-post ginned up last night saying, if you've not read about the free gold concept, now would be a very good time to do so. The argument of free gold is essentially that gold's price is finally freed in order to absorb surpluses, and in particular surpluses around energy and commodities, rather than treasuries and U.S. financial assets. And I think it's begun. I think free gold has begun. And if that's right, the reason why it's important is gold could have way more upside than many people think even possible. And I say that with JP Morgan having just come out with a headline today saying they think gold go to 8,000 to 8,500. Which I think is a very important statement coming from JP Morgan, because this is not like LukeGromen who can say, I think gold's going anywhere. JP Morgan says something like that. That has been run up a flagpole and been approved and vetted by a number of different very senior people at that organization, and possibly even the United States Treasury itself. So I think if you haven't read about free gold, read about free gold. From DW, discuss the occurrence of 3 separate Six Sigma events happening at the same time, which I think was yesterday, the day prior, and I don't remember what they were. Maybe it was gold and Japanese bond yields and something else. I apologize. I should have listed it here. At any rate, ergo, is this time different? What's it tell me? Tells me that multiple markets are beach balls that have been held underwater, managed, etc., and have been for a long time, and those forces are now being unleashed, either by choice or by force. And so translation, is it different this time? No. I think we're in a currency system transition. That's what we heard coming out of Davos last week, right? When you get a parade of different world leaders from around the world all singing from the same hymnal, that the rules-based global order is over, that the monetary system is changing, the leaders at that place, they are not proactive thinkers. And with all due respect, they're not. They're reactive thinkers. They are spokesmodels. They come out of Davos, they all say the same thing. That tells you something's been decided by the actual decision makers. So they're just reading the news. They're not making the news. So that's my take of some of these, multiple Six Sigma events. you're starting to see beach balls released that have been kept underwater for some period of time for political reasons.
The prevailing narrative regarding Chinese gold accumulation is fundamentally flawed. Unlike distressed selling observed in the US Rust Belt or during the 1998 Asian financial crisis, Beijing's aggressive buying signals strength and long-term stability. This strategic shift underscores a broader market rotation where capital is fleeing overvalued technology sectors in favor of tangible assets. Whether the AI boom is a bubble or a driver of raw material inflation, the trajectory for precious metals remains upward. This environment validates the free gold thesis, where the metal is finally unleashed to absorb global energy surpluses previously parked in US Treasuries. Major institutional forecasts targeting $8,500 confirm that this is no longer a fringe theory, but a recognized structural transition. The recent cluster of statistical market anomalies signals that the forces of artificial price suppression are exhausted, marking the inevitable end of the current rules-based monetary order. Let's get back to the interview.
Gold is going back into the system as a reserve asset and rising in price. It also means over time, you're going to see a weaker dollar against the creditor currencies because the currencies will reorder themselves around balance of payments around gold. So you're going to see the dollar fall against the yuan. Check. And remember, everyone said that wasn't going to happen last year with the tariffs. Dollar fell pretty notably against the yuan. You should see it fall against the yen. That hasn't happened other than the last recent days, but over time it should. Against the euro, and I think it's part of what's driving the euro up versus dollar down, even though the fundamentals for the euro seem to be so much worse than for America. And then also the dollar down versus the Swiss franc as well. So let's see, from PR, how would you think through capital allocation and first-time home buying in this environment, i.e. homes getting cheaper in Bitcoin or gold terms, but also fiat mortgage will be inflated away? Things are getting so crazy that if I was a first-time home buyer, I would not be evaluating a home based on financial terms. I would be looking at it on quality of life, quality of schools, looking to raise a family, whatever the reason is, safety, what have you. I would also note that at some point in economies with secular inflation, you can't get a long-term mortgage. And that's not something Americans are at all familiar with. But banks, while they might be late to recognize the inflated away game, once they do realize that game and that they're in a secular inflationary regime, they're not stupid. And what they're going to do is they're going to cut the term on mortgages from 30 years to 10 years to 3 to 5 years, depending on the amount of inflation. And in that world, a house stops being valued based on what someone can buy it with a 30-year mortgage because they don't exist anymore. And it starts being valued on the monthly payment of a 10-year mortgage or a 5-year mortgage or a 3-year mortgage, and maybe at a floating rate. And in that case, homes tend to fall to cash value. Where's the cash bid at? And in certain markets, that's higher than others, of course, certain regions, certain locales. But that is what happens to residential real estate in secularly high inflationary environments. So again, I think we're heading secular inflation, and there's a lot of wild cards. The Overton window is wide open. So don't buy your house because you think you're going to make a bunch of money on. Buy your house because you like the schools for your kids or because it's a safer place to raise your kids. It's where you want to raise your family, whatever. Don't do it for financial reasons, in my opinion. Right now, the reason why Bitcoin is trading as levered NASDAQ rather than neutral reserve asset, levered gold, is because capital flows are overwhelming it. NASDAQ, unspoken, NASDAQ has been heavily a capital flow phenomenon, right? The Chinese run surpluses with us. They don't want our treasuries anymore, but they'll buy our NASDAQ. Why wouldn't you, right? Obviously, you're seeing a lot of reasons why a number of different people around the world are being either shied away from recycling capital flows into the country, and certainly the Chinese are essentially being told, stop buying our NASDAQ. And so NASDAQ's a capital flow dynamic. If you look at the NASDAQ is down 45% versus gold since early 2024. So when we now transfer that to Bitcoin, well, what was once seen as, hey, by some Bitcoiners say, hey, 40% of Bitcoin in the world is controlled by Americans, so we can rug everybody else in the world by, selling our gold and buying Bitcoin. Well, the flip part of that is actually what's happening, which is 40% of Americans own Bitcoin and the world's taking money out of America. Well, guess what? Bitcoin's just levered NASDAQ. And so with capital leaving, Bitcoin's reacting to that. And with that happening, the world, is looking for safety, or at least in part. 60 to 80% of the world, a lot of that world has lived through currency crises in their lifetimes, or their parents have had that conversation with them and had that. And that conversation with 60 to 80% of the world's population does not look like buy Bitcoin. What it sounds like is buy gold. Gold in these cultures, in these countries, has a hundreds, if not thousands of year track record of protecting assets and their wealth during times like these. And so to the extent they need a neutral reserve asset, that's what they're doing. And Bitcoin is a completely unproven new thing to them. And some of them look at it with some skepticism as to its founding, etc. I don't necessarily worry as much about that, but I've had people from other countries ask that. So they are concerned about where did it come from? Who created it? So I think ultimately, when will Bitcoin start acting more like gold on capital issues, on sovereign bond math? I think it will require either more time or a lower Bitcoin price or a lot more drastic liquidity out of U.S. and global authorities, more nuclear printing, if you will.
As gold reasserts itself as a primary reserve asset, the global currency order is shifting, inevitably driving the dollar lower against creditor nations like China. This transition into a secular inflationary regime brings a stark warning for the real estate market. The 30-year fixed mortgage is an endangered species. Banks, realizing they are being inflated away, will likely slash lending terms to 10 or 5 years, forcing home valuations to plummet toward their cash realities rather than being propped up by long-term debt. Simultaneously, Bitcoin is failing to act as a neutral haven, trading instead as a levered NASDAQ, highly sensitive to U.S. capital outflows. While Western investors gamble on digital volatility, the global majority, comprising 60 to 80% of the population, is reverting to gold, prioritizing millennia of proven stability over unproven technology during this monetary reset. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.